In this video, we'll look at a study that compares two popular strategies, dollar cost averaging and buying the dip, to see which strategy actually works better for long-term investors. Hi, welcome to the Zero to Crypto. If you want more videos about investing, remember to subscribe to the channel. Dollar cost averaging, or DCA, is when you buy crypto at fixed intervals, monthly, weekly, or according to any schedule you choose. The key idea is simple. You buy regardless of the asset's price. That means you don't need to guess whether the market is going up or down. You just keep accumulating whether it's a bull or a bear cycle. On the other hand, the buy the dip strategy means you only invest when prices are falling. When a cryptocurrency dips, it can look like a chance to pick up coins at a discount. But the challenge is knowing how far the price will continue to fall. You need to time the market for this strategy to work well. Nick Maggiulli did a study comparing DCA and buy the dip. For DCA, he looked at an investor who invests $100 every month. For buy the dip, he assumed an investor who saves $100 each month and only buys when the market enters a dip. And in this scenario, the investor magically knows exactly where the bottom is between any two all-time highs. Logically, this seems unbeatable. If you know the exact bottom, you always buy at the lowest price relative to previous highs. But when you actually simulate the strategy, buy the dip underperforms DCA more than 70% of the time. Take a real example from today. Bitcoin is currently around $90,000, and if you zoom out, you can see that the price has already increased more than 5x from the $17,000 bottom. The market sentiment right now is terrible, so the big question is this the bottom or not? The truth is, we have no idea. Let's say you're new to the market. You have $1,000 in capital, and you believe $90,000 is the bottom, so you go all in. You buy right now, and then the price keeps dropping to $50,000. Your portfolio is now cut in half. This means Bitcoin would need to double from $50,000 back to $100,000 just for you to break even. Now, consider the opposite scenario. You think $90,000 is still too high, so you wait for a lower bottom. But the following week, the Fed cuts interest rates and Bitcoin shoots from $90,000 straight to $200,000. You're sitting outside the market, holding cash, watching the chart explode, feeling regret because you didn't buy at $90,000. Instead, if you split your purchases and DCA, let's say you buy $100 every month, then if the price jumps to $200,000 next week, you've made a profit on the amount you already bought. Easy money. And in the opposite case, if the price drops to $50,000, you keep averaging down. Your average entry might end up around $60,000, meaning you're actually near the bottom. Now, Bitcoin only needs to rise about 20% for you to break even instead of needing a full 2x recovery like when you tried to perfectly catch the bottom. To understand why trying to catch the perfect bottom is so risky, let's look at a simple illustration based on long-term market behavior. Imagine you invested regularly into a major index like the S&P 500 for 20 years without pulling your money out. Over time, your portfolio would naturally grow as the market trends upward. But here's the surprising part. If during those same 20 years you happen to miss just the 10 strongest up days, the big recovery days that usually come after sharp declines, your total return could drop to less than half of what a fully invested person would have made. And if you missed around 15 to 20 of those days, which is extremely common for people who sell everything and wait for a better entry, your long-term performance can fall to near zero or even turn negative. What's interesting is that these powerful up days often appear right after major drops, exactly when most people are too scared to buy and prefer to stay in cash. As a result, they end up missing the most important days of the entire cycle. This leads to one clear conclusion. The more you try to time the bottom, the higher the chance you'll be outside the market during its strongest rebounds. And missing just a handful of those days can erase years of growth. What makes the buy the dip strategy even more problematic is that we have always assumed that you would know when you were at every bottom. Unless you have a time machine, you will not be able to achieve that. With the variation of buy the dip where the strategy misses the bottom by 2 months, DCA outperformed the buy the dip 97% of the time. So I believe that the best option is the DCA, since you don't have to time the market, and the study shows that it will have a good chance of outperforming the buy the dip strategy. If you liked the video, please hit the like button and subscribe. Bye.